This video is a video that will show you the plausibility of an event. And this is why you don't want to refinance to either get to cash out of your equity or to recast a rate and payment or any other conventional approach to trying to save money when it comes to a mortgage. I'm going to show you a better way to bank and borrow so that you don't keep recasting 30-year and 15-year notes and giving your money to the bank. You need to keep your money and mitigate interest costs and mortgage payment over the timeline of mortgages. So this is a conventional 30-year mortgage. This particular instance is a $250,000 mortgage, 30-year, 3%, pretty average for today. The individual data that I'm going to show you of this individual had been in his loan for 5 years, and he was thinking about refinancing to a 2.25% interest rate. And you would think that 3/4 of an interest rate would make a big difference. And let me just show you that. Because conventional thought tells you that 3% financed $250,000, he's got $1,054.01 mortgage payment. That's principal and interest. And there's a lot to unpack here. I could talk about how little is going towards principal, how much is going towards interest, how much interest you're paying over the time. Up to this point, he's paid $36,000 in interest and only $28,000 in principal. So over 60 grand has gone towards his mortgage, and he still owes approximately $222,000 after 5 years. If he refinances, he's going to $222,000 at 2.25% and start the clock all over again. So you see he lowered his payment by a couple of $100, $1,054 to $848. A lot of people would think, okay, great, I'm going to cash flow $200 a month. Well, let's go back to $250,000, and I'm going to show you why that's not a good idea. You think you're saving money, but you're not. The bank is tricking you into thinking that you're saving money because now you're starting this interest payment all over again. And at the end of 30 years again, there's $83,000. Remember, you already paid $36,000, so there's $110,000 in interest. So let's recalculate to the original loan amount, the $1,054 payment. Okay, we're back at the original $250,000 mortgage, 30-year, 3%, $1,054 payment. Fast forward 5 years, he's already paid $36,000 in interest and only $27 or $28 in principal, and he still has 25 years to go. Now, what we did was we took his finances and we ran it through our calculator. We took all of his expenses. He's got $25,000 in credit card and car debt, which worked out to about $550 a month out of his pocket. And remember, this is not an instructional video. This video is not intended to educate you to the fullest so that you can go out and do this, because I don't suggest you try and do this on your own. We've been doing this for 15 years. We've got an A+ rating at the BBB. We've got a near 5-star rating with Trustpilot. We've been doing this a long time. We know what banks to take people to. We know all the nuances of every moving part. And this is why we're successful with helping people get more out of what they own and what they earn. Just by adding a line of credit second of $25,000 to this person's financial landscape, we will have him paid off in 7 years and 6 months. That's the credit card debt, the vehicles, and the house. So he has a $222,000 outstanding mortgage at 3%. Let's not touch that. Let's leave it alone. Let's get him a line of credit second, borrow $25,000 immediately out of the line of credit, and pay off the credit cards in the car. Now he's got $550 a month coming back into his pocket. But you say to yourself, well, you refinanced the cars and the credit cards into a lower interest rate. How is that helping? The secret is to cycle income through a credit instrument that allows you to mitigate interest cost and replenish that principal balance. If you'll notice in this column, available funds, takes out $25, but he immediately recovers $2,600 the first month. And each month thereafter, because he's cycling income through it and treating it like a checking account. And then periodically we have him borrowing around $15,000 a month to throw towards the first. So that lowers the first. And over time, periodically borrowing, when it makes sense, this mortgage pays off in 7 years and 2 months. Then he has a slight outstanding balance in the line of credit because he borrowed from it. And now that's paid off in just a few months. So that achieves a 7-year and 6-month payoff of all debt without refinancing. Now, this is a little known secret called credit line banking. We developed it back in 2002, 2003. There have been other banks that tried this, but they failed because they don't know how to teach consumers how to use it. They can sell the loan, but they can't teach people how to set it up. And that's what we have perfected at Truth and Equity. So I encourage you to go to Truth and Equity, watch the video on the homepage because it tells you why you would do this. It shows you how. This video right here shows you how to set up your information so that it can output the results and give you a summary report. And then you schedule an appointment with us and we go through the details of your financial landscape so that we can achieve results similar to this. Don't refinance. Don't let these low rates sucker you into refinancing because you're going to save a couple $100. It's a trick. Let us show you how to do it so it favors your pocketbook. Let us teach you how to get more out of what you own and what you earn with a little known secret called credit line banking, and let us set this up for you. Remember, this is not an instructional video. There's a lot to unpack here. This is why you schedule a call with us, because there's a lot to talk about and everybody is different. So take the time, give us your information, see how we break all of this down. These are all the expenses, in and out, income, everything. We take a full 30,000 foot view of what you're doing today, run it through our calculator, and assemble a plan that makes sense for you. Now, this is why we say you could pay your house off between 5 to 7 years. In this particular case, it's just slightly over 7. But typically, our customers pay off between 5 to 7 years, and we're the original developer of that pay your house off in 5 to 7 years. There's a few copycats out there, but they don't know how to drill in because they don't have this tool. You take the time, schedule an appointment, let us run your information through here.